Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we are watching this hour. First up, President Trump touring the Fed. We'll discuss the state of the Federal Reserve, its independence, and whether a rate cut should be on the table. Plus, we push ahead to big tech results with Apple, Amazon, Meta, and Microsoft. They're all set to report in the coming days. Plus, Paramount and Skydance get the okay from the FCC. What's next for the streaming industry? All that and more coming up on Market Catalysts. Let's get a check on the markets, though, first of all, here this morning, because we are seeing a rally across the board, albeit a modest one. But remember, any gains, though modest they may be for the S&P and the Nasdaq, would mean record closes yet again. Both of those indices up just about 0.2%, not even. The Dow, the smallest gain of the day, up about 30 points. That's not even 0.1%. And also, let's look at the bond market here this morning. Ahead of the Fed's rate decision next week, they're broadly expected, of course, to not change rates. We are not seeing much change in rates today, actually. 4.42% is where we stand on the 10-year. Well, President Trump touring the Federal Reserve with Jerome Powell yesterday, repeating his call for lowered rates, but seemingly pulling back on potentially firing the Fed chair.
To do that is a big move, and I just don't think it's necessary. And I believe that he's going to do the right thing. I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes.
I want to bring in Nancy Tengler, Laffer Tengler Investment CEO and CIO. Nancy, it's always great to see you. It was pretty extraordinary yesterday to see Trump and Powell there with their hard hats on, Powell correcting Trump on some of the renovation figures in real time, and the two talking about interest rates a little bit. Now, I know that you, for a while, have not been on the same page with the Fed in terms of interest rate policy. Do you think that they should be cutting next week?
Well, I don't think they will, Julie. I think this Fed has demonstrated that they've been wrong at every turning point. And, you know, if we did that in our business, and you know this well, we would be out of business. So I actually think the most constructive thing that's come out of this is Secretary Bessent saying, I'm going to just review the entire institution because I feel like they've lost their way. You've got 450 plus PhD economists plugging into models they don't use. You got the Fed driving through the rearview mirror and then consequently being late and wrong at every turning point.
Well, Nancy, can I get you to pause there? What says that they're so wrong and so late? The U.S. economy, or maybe you don't think so, the U.S. economy seems to be chugging along okay, right? So what's so terrible about what they've done?
Yeah, well, so they were wrong. He was wrong in 2018, and we got the 2018 bear market. He raised rates in the face of tariffs because he thought they were inflationary. They weren't. He was wrong in 2020 by letting rates, and 2021, I'm sorry, by letting rates, by letting inflation accelerate while he kept talking about transitory. He cut in the fall 100 basis points, and the 10-year rose by 100 basis points. So that's the history. And then if you go to current time, what we're hearing from, the housing, the home builders as they report is that, this morning we heard from Reddit that 15% of contracts are being canceled. Now, we heard from D.R. Horton that 64% of their new home buyers were new home buyers. But what's happening is they're waiting. So the average age of a millennial home buyer is 38 years old. So we're locking out a whole constituency from housing. And I think that is something that has to be taken into consideration.
Okay, so you're saying you think that the dual mandate of the Fed needs to be reconsidered then if you think that they should be taking into account things like affordability?
Well, I think pricing is an important aspect. We've got inflation back to levels that are manageable. If you look at my analogy to the 1990s, what you'll see is that, it is possible to have robust stock price returns as we did in the 90s, coexist with higher interest rates and higher inflation. But we also had an environment where the affordability was there because wages were rising so quickly. We have seen wages rise, real wages, but wages, sorry, say that 100 times fast, real wages, but they haven't risen by very much, Julie. So, I may be fine, you may be fine, but this lower income cohort that lives paycheck to paycheck is being locked out of the housing market. And I do think that has to be a consideration overall.
So whether you think that the Federal Reserve's sort of dual mandate and structural reasons for raising or lowering rates should be reexamined. Okay, let's put that to the side for a moment. Do you think that the Fed should be an independent entity of the executive?
100%. 100% I agree with that. And I don't like what the president's doing. I'm not advocating for hammering the Fed. I think that's left to people like me and the market and the bond market. But that's what we have, and we've had it before. Remember, Lyndon Johnson picked up his Fed chairman and threw him against the wall back in the day, trying to intimidate him. So I don't like it, but I think the Fed needs to reconsider looking backward and really being focused on tariffs, when during the Biden administration, we spent something like $6 trillion, and he wasn't at all worried about that, which really was the accelerant on inflation, was profligate fiscal spending. So I just find the inconsistencies and the lack of humility a real problem, because in our business, if nothing else, you have to be humble.
Right. Well, I'm sure we'll keep talking about the Federal Reserve, but I also want to shift gears and talk about earnings with you, Nancy, because we've got Meta, we've got Microsoft, Amazon, Apple. They're going to be the next tech stocks to report earnings for the second quarter. I know you hold a lot of these companies, and so I'm just curious, big picture, how you're thinking about how to sort of play them, or how you're thinking about framing them going into the numbers.
So if we're in a slow economic growth environment, and I think we can say, it's positive, but it's not robust. So maybe we get GDP average first 2 quarters, 1.5%. You want to own the reliable growers, and that happens to be communication services, which is expected to grow earnings at over 32%, and technology at about 18%. That dwarfs every other sector in the S&P. The next closest is financials at 9%. And that's based on already reports and then expectations on reports. And it's a little bit higher than it was a few weeks ago. So these are the names we want to own. Now, we have been pivoting. We pivoted to a lot of the infrastructure names about a year ago. We're now pivoting to housing because we do think rates are going to come down. But you want to own these companies because they're driving this next wave of productivity-driven growth. We've been talking about this for 3 years, and I think we've been right, and I think it's going to continue for some period of time.
Now, do you want to own, and we're going to dive more into the chip makers in just a moment, but you look at the hyperscalers here, we're about to hear a lot of them, and Meta has gotten a lot of headlines lately for all of the money it's throwing at talent, and by the way, it's spending on CapEx too. Where do you think they stand versus the others? And I think Meta is one that you don't own.
We don't. We sold it, Julie, I'd say about 2.5 years ago, but we bought Spotify. So it's always a question, am I sorry I don't own Meta? Kind of, but you can't own everything. Spotify's done better over the period of time that we've owned it. And so I think I just don't happen to like the model. That's silly, I guess, because the stock price has defied my particular bias, but we own the rest. And I think you saw from Google a pretty low valuation compared to the rest of the names, and a decent earnings report with an increase in CapEx spending, which is going to help a number of the other names that we own. But we've put our bets in Microsoft, Oracle, Amazon, on the hyperscaler. I know Oracle's technically not a hyperscaler, but it may be soon.
Yes.
And so those are the names that we like, and those are the ones we're going to be paying attention to. And we're looking for an opportunity to add to Apple. So next week's going to be pivotal for us.
Oh, interesting. Yeah, and of course, those other guys have mostly done well, ex Meta, even if you didn't own Meta. Nancy, you're going to stick around. As I mentioned, we're going to have a chip makers chat in just a moment. But first, we are going to zoom in on one of the chip makers in particular. That's Intel. The shares taking a hit during early trading today. That's after investors failed to be impressed by CEO Lip-Bu Tan's turnaround plan for the company. Intel sharing plans to cut its workforce by about 20% by the end of the year and trim its operating expenses. Shares down 9%. Stacey Raskin is Bernstein Managing Director and Senior Analyst. Stacey, joining us now. You've got a market perform rating on this one, $21 price target. And you said in your note reacting here, the earnings were actually not bad, but do the earnings matter? Like, what matters to investors when it comes to Intel right now?
And the numbers don't matter. That was my take even into the print. Like, who cares about the numbers, right? The question is on, the strategy and what are they going to do? And, is their process roadmap any good or is it not? And are there going to be foundry customers in a foundry business that is robust or is there not? Like, those are the questions that matter. And we got a little bit of color on that last night. And that's part of the reason the stock is doing so poorly today. Like, the numbers overall were okay. It was actually a decent beat in the quarter. They missed earnings, but there were some one-time charges in there. The revenue guidance was pretty solid. Again, earnings margins were a little lower, but I mean, who cares? The biggest issue was around their process roadmap, particularly their next generation process. I'm going to throw some numbers out, but they named their processes after nominally the size of the transistors. The one they're getting ready to ramp is called 18A.
Right.
This is the one that the prior CEO, Pat Gelsinger, had sort of bet the company on effectively, right? Now it's turning out like 18A is not, it's 14A, which is, I guess, the next one that's going to potentially save them. That is the node that if they can build a foundry business that they will build around it. And it didn't sound like they were entirely confident. And so they actually put some risk factors, new ones in their filings, and they talked about this on the call. They basically said, we cannot afford to develop 14A if it is only for us. We need external customers. And if we can't get external customers, we may have to stop development on our forward process node. So it didn't sound like that they were incredibly confident on their ability to get that node developed and ramped. And frankly, to my mind now, the call on the stock is pretty simple. Can they get a hero customer on that node, which they don't have a process for yet? Can they get a hero customer in the next 12 to 18 months, a customer that is big enough to make that node viable? And if they can, maybe there's a story here. And if they can't, then it's a problem.
Yeah.
And right now we have no basis to make that decision one way or the other. And hence the stock is selling off pretty sharply today.
Yeah, I mean,
there was a definite change in tone.
Yes, and just to zoom out a little bit for people who haven't been as steeped in this, if you look at the numbers here, the annual sales of this company have gone down by something like 20 billion over the past few years. So we've seen this shrinking. What is the place of Intel ultimately in the semiconductor universe? What role does it play?
So let me talk about their products and then talk about this sort of future, right? So the current products, they sell mostly chips for PCs and chips for servers. And chips for PCs is fine, but PCs, I mean, they had spiked during COVID, and we've been in a hangover position. But that market's not really growing, and they're losing share. And then in data center, I mean, they've been decimated. They have sort of 3 layers of share loss. They're losing share in the chips that they make to their competitor like AMD. That architecture that both of them make is something called x86. x86 CPUs in servers are losing share to another architecture, which is called ARM. And you've got big customers like the hyperscalers that are starting to build their own chips. And then CPUs in the data center in general are losing share to GPUs, to players like NVIDIA, right? And so they don't really have an answer to any of those. And again, their data center revenues have collapsed over the last several years because of this. So in terms of the products that they sell, they're certainly less relevant than they were. And there are other competitors now that are much bigger and still growing.
Yeah.
Now, in terms of the future, look, people would say, Intel's the only sort of US-based source of purportedly leading-edge semiconductor manufacturing, which is a huge sort of geopolitical and strategic effort of the government. So there's this view that we need Intel. And I guess that's true, except that Intel is now cutting back on their efforts here. They're actually delaying their big build-out in Ohio even further. Right. They're cutting their CapEx. They're cutting their headcount. And you've got competitors like TSMC, for example, who are actually building a large amount of capacity here in the U.S. And I could make the argument that the longer Intel waits and the longer it takes them to ramp the stuff up, the more capacity is getting built here in the U.S. by other players. Maybe the less we need them over time. And now they're basically saying, if we can't, and by the way, it's smart. You can't build these factories with no customers. That was the problem that Pat Gelsinger, that was his strategy, didn't work. But I mean, if you, now they're basically saying if we can't get customers, we may have to give up, and sort of that puts the onus even more on TSMC. But the longer that they wait, maybe you could make the argument that maybe the less we need them. But I don't know. Again, it's this kind of dichotomy and this uncertainty that's weighing on it.
Yes, most definitely. It sounds like a pretty bleak picture. So Stacey, I'm going to ask you to stay with me because I'm going to make it a little bit more of a positive picture. and turn our attention elsewhere from Intel. I want to bring Nancy Tengler back into this conversation because Nancy owns a bunch of chip makers.
Okay.
I think you guys are on the same page when it comes to NVIDIA. You've got a bioequivalent rating on it, Stacy. Nancy likes that one. Let's talk about Broadcom for a minute because, Nancy, this is one that you've liked for a while. Do you still like it? What are you going to be looking for from Broadcom, Nancy, going forward?
Yeah, we do, Julie. I mean, it's our largest holding across all of our large cap equity strategies, member of our 12 best, our 5 for 25. I think, and it's outperformed NVIDIA pretty handily over the last year, almost double the returns for NVIDIA on a trailing 1 year. We've always called it the poor man's NVIDIA. I think we're going to have to come up with a new name. But one of the things that we're going to be paying attention to is, of course, the AI revenues. We've seen those compound at 60+%. They've announced new partnerships. We want to hear more about that. It seems that the rest of the business, the rest of the chip business may have bottomed. We'd like to hear some information and confirmation about that. And then I just think, it's just going to be about the future guidance. And Hock Tan has demonstrated he can acquire companies, make them accretive quickly. We bought the stock when it sold off on the Computer Associates. That used to be the name of the company they acquired. Wall Street didn't like it. They turned it around, made it a very positive acquisition. So we'll be listening for that too. Are there any acquisitions they're planning to make? And I certainly hope one of them is not Intel.
Yeah, yeah, that would be something. Stacy, along with NVIDIA, is Broadcom are those the sort of must-owns in the chip space?
Yeah, I'm frankly, in chips, it hasn't been great outside of AI, right? I mean, AI has been super strong. The analog, more diversified guys, like the people were playing those on cyclical recovery. Some of those prints so far this earnings season have not been so great. And there's worries about pull forward and everything else. Again, you got companies like Intel, which frankly are a basket case. I mean, if it wasn't for AI, the space would not be doing very well. So I do like the AI names. We cover NVIDIA and Broadcom. I like them both. Broadcom is just more expensive than it used to be. That's the only.
Right. I guess hence Nancy's comment that they're going to have to rename it from the poor man's NVIDIA.
Mean, look, you got to remember Broadcom. Like not all that long ago was like 16 times earnings. Like now it's like the multiples like doubled, right? They are showing a lot of AI upside. A lot of that comes next year, but they're clearly. I mean, even in the last earnings call a couple of months ago, they're clearly calling for upside in their AI revenues next year on more inference demand. They're a massive player on AI networking, right? So there's a big play there. And Nancy, I think, is right. Their core semi business, which admittedly has been lousy, they're not the only ones. Everybody in those kinds of markets has been lousy. It doesn't look like it's getting any worse, at least. We can argue about when it's going to start getting better. I don't know yet, but at least it isn't getting worse. If you're looking into the near term, I mean, you could argue, again, we like both stocks. NVIDIA is cheaper. And they just got their China licenses reinstated, so there's probably more upside to their AI numbers this year for NVIDIA versus Broadcom. I think the Broadcom AI upside comes next year, and Broadcom's a little more expensive. And then there's a whole ASIC versus GPU debate. But I think you can own them both. Like I like them both. And again, AI is the only thing in semis right now that fundamentally is really working.
Stacy, Nancy, gotta leave it there, but this was fun. Let's do it again, maybe once we get closer to those NVIDIA and Broadcom earnings. Thanks so much.
Yes.
Thank you.
Coming up, we'll bring you the latest in trade negotiations from President Trump with 1 week to go until that August 1st tariff deadline. That's next when we return. President Trump gave more details Friday about the state of trade negotiations. He said the U.S. is nearing a trade deal with China and offered a range of messages on other nations facing his August 1st deadline. Trump's comments coming as U.S. and Chinese negotiators are set to meet in Sweden next week. Joining us now, Wendy Cutler, Vice President of the Asia Society Policy Institute, and Yahoo Finance's Washington correspondent, Ben Werschel. Ben, let's start with you. Give us the latest here on some of these comments that we heard from President Trump today.
Yeah, so this morning as President Trump headed for Scotland, he did about a 30-minute gaggle with reporters talking about a wide array of topics. On the financial side of this, which was one piece of this, there was kind of a mixed bag here in terms of trade updates. The first one was kind of some tough words about the current talks. He talked about these are the countries facing an August 1st deadline. He described the chances of making a deal with the EU as not certain. At one point he described it as 50-50. At another point he described it a little better than that. But it's clear that there's a ways to go on that front, which is of course, as a bloc, is America's largest trading partner. He had some negative words about Canada, saying that the outcome with Canada on August 1st could be a tariff and not any more negotiations there. What he previously promised was a 35% tariff on Canada, our northern neighbor. And he also talked about more tariff letters coming next week. This is where he basically just dictates rates. I might take that with a grain of salt, considering these are the final stages of negotiations, and we're seeing a lot of negotiations from both sides, including from the EU side, about what happens if no deal is there. But some negative words there. Where it was a little bit more mixed was on China. This is another big focus of trade this week. Or next week with Trump's team headed to Sweden to meet with Chinese officials. Trump describes that having the confines of a deal, but he didn't have any more details on what that meant. Right. He's previously described a 90-day pause as a deal, quote deal. So it could just be a reference to that, but we'll see if that emerges to anything more there. One area with the China talks that jumped out at me this morning was Trump was asked about currency and had a lot of words there. I wrote about this week about how the weakening dollar is a real sort of challenge, and it is sort of dividing the Trump administration in terms of there's benefits of a weaker dollar for trade, and there's also disadvantages. Trump said that China, all they do is fight for a weaker currency. So that's clearly an issue for him in these China talks. We'll see if that comes up more. And then one final positive note from the president this morning was a lot of positive words for Jerome Powell. This came after his high-profile visit to the Fed yesterday. He talked about how Powell's a very good man, and even hinted that he thinks, we'll see if this happens, that Powell is going to look towards lowering rates as soon as next week, at least advocating for that, if not actually lowering them.
Yeah, we'll see about that part. But let's talk more about the potential China deal. Wendy, I want to bring you in on this. What should we be watching for on this China deal? What developments do you think could come next week?
So again, next week is really, in my view, more of the launch of the China negotiations, right? It's taken us 2 or so months to make sure the deal that was reached in Geneva held up, particularly with respect to critical minerals. So I think when Besson takes his team over and meets with China, it will be all about trying to come up with a deal that could be announced during a potential Trump-Xi meeting around the APEC meeting come late October.
Interesting. What would you want to see out of that deal, or what would you expect to see out of that deal when it comes that would be sort of most favorable to the U.S.?
Well, look, I think the president is going to be pushing for big purchases. We've seen that in other deals that have been announced so far. We've seen that during his first term. And so I think that would be a feature that will be worked on. The Secretary of Treasury has also mentioned his concerns about Chinese exports of excess capacity goods. So I think that's another critical area that needs to be addressed. And look, there are a whole host of non-tariff measures and tariff measures that also could be on the table as well.
Ben, just a reminder for folks, August 1st is not the deadline for China tariffs to go into effect. That's August 12th. And Treasury Secretary Besson has said that date is likely to get pushed back after the talks next week. What should we be watching for there?
Yeah, so I think you're right that there's a lot of optimism that piece of these talks is indeed likely, as Secretary Besson has said. But that's, I think, what the markets are watching most closely, basically getting that deal done, and then, as Wendy said, kind of launching the larger talks. What we've seen is talks so far in Geneva and in London that are essentially about putting out fires and lowering the temperature so far, and then they have to do that with these an additional 90-day pause, presumably, and then they get into these larger talks. We'll see how far they're able to get in terms of these purchases and all these other issues that they have in front of them.
Wendy, do you think that there will be successful negotiations on things like rare earths or on TikTok? I know those have been some of the issues in the past. You know, are the two sides going to be able to get to agreement on this stuff?
Well, look, rare earths for the United States is just a key issue. And right now we do have some kind of deal with them that those critical minerals and those magnets will be coming to our market. But I think we will be seeking more more assurances there. And I would also just say, I see that the tariff rollovers, it will start on August 12th, but I don't think we're going to be going back to the high tariff rates with China again, barring some unforeseen development.
Wendy, I wanted to ask you one question about a deal we saw this week with Japan, specifically a $550 billion, what the White House is describing as an investment vehicle that with Japan presumably sending money to the U.S. Is that something you've ever come across in your time as a trade negotiator? And what are the consequences there in terms of this actual money as well as with other deals?
Mm-hmm. Well, no, this is novel, right? We've seen under Trump 1.0 purchases, but the notion that an investment fund would be set up, and we're talking a dollar figure of $550 billion, $550 million, but
billion
dollars.
Yeah, billion. It's a big one.
Billion. I'm sorry. Okay, I said billion.
That's
and then
okay.
I'm like,
You say the number and you're like, wait, is that right? That's a lot of money.
But I will say, when you read the Japanese press on this, there are a lot of disagreements already on the contours of this fund, including who's going to be controlling it, how Japan's talking about, it could go up to 550 billion. But I think there are a lot of details that need to be worked out here. I understand we're asking Korea to do something along the same lines. I wouldn't be surprised if this becomes a request to Taiwan as well. I think, the dollar figure may be less, but I think this is going to be a feature. When you read the White House fact sheet on the Japan deal, it's all about this investment fund.
And quickly, Wendy, is that then a recipe for further friction down the line?
Well, absolutely. It's one thing to announce something, but if you start having disagreements on what was agreed to so early after a negotiation, it does not bode well for smooth implementation.
Yeah. Wendy, thank you very much, as always. Great to get your perspective. Ben, thank you very much. Both of you have a great weekend. We got much more markets action coming up, including a deep dive into the tariff impact on supply chains. Stay tuned. You're watching Market Catalyst. Supply chain technology provider Manhattan Associates reporting second quarter results earlier this week, boosted by demand for its cloud services. Joining me now is Eric Clark, Manhattan Associates CEO and President. Good to see you, Eric. Thank you for joining us. Before I sort of dive into your numbers, I do want to talk about tariffs and the trade war, because obviously your clients are sitting at the intersection of all of those cross currents. What are you hearing from clients right now as to sort of how they're navigating the tariffs?
Yeah, well, first of all, thanks for having me. And what we're seeing is early days when these tariffs were announced right after Liberation Day, lots of customers maybe went into a little bit of a pause mode to try to predict what was going to happen or to try to understand the uncertainty. Since then, I think people have understood that this isn't going to be quick, and some of these deadlines are going to move, and it's going to take some time. So the forward-leaning companies are really getting back to their strategies and executing their strategies. And I think it's not too dissimilar to what we've seen with other supply chain disruptions like COVID and bridge collapses, et cetera. While there's a little bit of a pause in the beginning, I think it very quickly confirms the fact that supply chain is mission critical software. And this is not an area that companies are going to pause or delay for a long time. This is an area that they consider not only mission critical, but strategic.
At the beginning of the year, we were also seeing not just some contracts being paused, but the opposite in some cases, right? Orders coming in to try to sort of front run the tariffs to build up inventory. Is that inventory now, has it been worked down? In other words, I guess right now, how would flows compare to normal conditions?
Yeah, it varies across industry, and what we're seeing from our customers is they're trying to be prepared for whatever might come next. And from a software perspective, that's what we do. We can help them, be prepared and make sure that they can react and have their correct strategies and agility so that they can do the things that they need to do in real time.
And so when it comes to your business, I know that, a lot of the contracts that you all signed are sort of longer term contracts, right? Have you seen any disruption to that? Have you seen any of your customers sort of pulling back on spending amidst all of this?
It's interesting. As you mentioned, we announced earnings earlier this week, and we had a strong Q2 and a strong first half. It was a beat and raise quarter, and with really strong margin expansion. And when you look at the difficult and uncertain macroeconomic environment, the past 3 quarters at Manhattan have been our strongest bookings sales quarters in the history of the company. So you can argue that all 3 of those quarters were, if not challenging, at least changing macro environment. And we continue to do well from a bookings performance. And not only that, but new logo bookings has been the strength of our bookings performance. So we're able to actually go out there and take market share from our competitors. And that also gives us opportunity to continue to expand and cross-sell into those customers in the future. So we're feeling really good about the commitments that our customers are making and that customers in the supply chain space are making with their supply chain software.
And Eric, would you say, I think sort of during the pandemic, we all paid a lot more attention to supply chains than we ever had, of course, because they were affecting us directly. But there was also a lot of discussion about how antiquated the systems were, both the actual physical infrastructure, but also sort of the things that you help people do now, right? That stuff was sort of obsolete in many cases. Where are we now, and how much further does supply chain modernization need to go?
Well, I think we're in the early days of supply chain modernization. And at Manhattan, I think we're rated a leader across our product portfolio. And I think we're really the only true cloud-based SaaS provider across the supply chain space. And that's why we continue to have high win rates in the market. And that's why we continue to drive that expansion with these strong bookings quarters. Again, I point to with this uncertainty in the market, it is confirming the fact that this is mission critical software and confirming the fact that this needs to be part of the strategy. And that's why people are really leaning into the modern technology that we can offer.
Eric, thanks so much for joining us. Appreciate it.
Yeah, thank you.
We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePompa live at the NASDAQ. I want to take a look at all 3 major indices right now, roughly flat as we make our way into the trading day. About an hour in now, taking a look at all 3 major indices, up about 0.2%. In particular, what we've seen over this past month to date is really the S&P 500 outperform after better than expected earnings have really wowed investors. Certainly, we've heard not only from many companies, but 1/3 of the S&P 500 index has reported their earnings by Thursday's close. And what we've heard so far is that they're more robust than what Wall Street had expected. Around 83% of companies have exceeded analyst profit estimates, and that's on track for the highest share of beats since the second quarter of 2021. And taking a look year to date for the S&P 500, it's been quite the run here. Carson Group, Brian Dietrich, friend of Yahoo Finance, said this morning that the S&P 500 has closed above the 200-day moving average for 62 days in a row. That's the longest streak since 1997. The close we're looking for there is above 6,363.35. So certainly if we stay in this territory that we're at now, that will be another record high close on this Friday. Also taking a look at the NASDAQ this morning, that's also an index that we've seen hit record highs and is still holding on to that momentum. We're looking for a close above 21,057.96. That will certainly be another record high. Now, even though the indices are flat, once again, any notch higher will be a good news here for another record week. Some leaders in this space right now, as you see year to date and really over this past month or so, we see these AI leaders really rallying to those record highs. NVIDIA, Microsoft, Meta, certainly investing in that AI trade, and we've seen that play out, as well as AMD. Some stocks under pressure this morning does include Intel. We know that Intel's shares there are down more than or nearly 9% this morning. The company there hinting towards some cost-cutting initiatives, and certainly there's been fear on the street that they've fallen behind that competition from AMD as well as Qualcomm. But keep a closer eye on Apple. Keep a closer eye on Meta and Microsoft. All 3 of those tech giants are set to report earnings next week. They've had quite the run year to date, and we'll certainly be looking out to see if they can hold on to that momentum. Keep it right here on Yahoo Finance. We'll be tracking all the market moves during today's trading session. I'm Brooke DePompa. Thank you.
Now time for some of today's trending tickers. We're watching Charter, Tesla, and Volkswagen. First up, Charter Communications falling after the cable company reported second quarter earnings that missed expectations. The company reported it lost more internet customers than expected during the second quarter amid increased pressure from mobile companies' 5G and fiber home internet offerings. All three of the big U.S. telecom companies have been packaging their offerings of wireless phone service with 5G or fiber internet service. Those shares down 17%. Next up is Tesla. Two narratives in focus for that company today. In the first, Business Insider reporting the company will launch its robo-taxis in San Francisco this weekend, which did help stem some losses for the shares this morning. They're now up more than 2%. On the flip side, however, speaking to the future of Tesla, The Information is reporting some struggles in Tesla's Optimus robot production, saying the company's only made hundreds of robots. Well, why does that matter? As the company grapples with falling auto sales, Musk has been hyping his humanoid robot as Tesla's next big product, a potential $10 trillion business, and has talked about producing 5,000 of those robots this year. So they're going to have to speed it up if they're only at hundreds. Finally, Volkswagen lowering its full-year guidance and reporting a sharp drop in second quarter profit as the auto giant grapples with the costs of President Trump's trade war. Europe's biggest car maker posting second quarter sales of 80.8 billion euros that missed analysts' expectations of more than 82 billion euros. The automaker said the impact of U.S. tariffs alone cost it 1.3 billion euros in the first 6 months of the year. Well, joining us for more on Volkswagen, Pras Subramanian. And Pras, I thought of you immediately when I saw this because you have been tracking these European automakers so closely and what they've all been saying about tariffs.
Yeah, and I think that this is not a surprise given, Volkswagen's sort of heavy presence, not only in Europe, but also they build a lot of vehicles in Mexico. So they're going to be hit by those tariffs. And it, as you mentioned, came in at about $1.5 billion in tariff hits in the first half. And, obviously that's going to continue this for the back half of the year unless there's a deal made in place. And, and with that said, VW slashed their revenue estimate to be in line compared to last year as opposed to a 5% gain, and then brought down their operating margin too, right? But they're kind of saying it's in a band, right? So the upper bound or the band that's actually not as bad would be a 10% tariff, right? That means they would have a higher margin. But if it's a 25%, then it kind of gets hit even more. Their margin comes down a bit more by almost 2 percentage points there. So that's not great for the company. But VW CEO Oliver Blume said after the call that he hopes the deal will materialize before the August 1st deadline that's sort of in place here with Trump, and that they actually might have a separate bespoke deal made with the White House, potentially down the line, contingent upon investments in the U.S., where they might actually start building some Audi premium luxury vehicles in the U.S. as opposed to building them elsewhere, like Germany and Mexico.
That is interesting, and presumably why the shares are up a little bit here this morning, Pras. And just quickly as well then, what is the VW current U.S. manufacturing footprint?
So they have a rather large facility in Tennessee where they build almost 1 million vehicles they could build in that facility. It's a gigantic Chattanooga, Tennessee facility. But obviously they can't build everything here. And that's why they're using Mexico for certain products. And I think that there's a possibility of not only extending the sort of lines in Tennessee, but then also building somewhere. And notable that they actually build in places like Tennessee where it's a right to work or non-union state, whereas in Germany, everything is fully unionized. So it's interesting that they might actually benefit potentially them down the line if they actually move their production to the U.S.
Pras, good to catch up with you on this as always. Appreciate it.
Thank you.
Coming up, we're going to hear from the CEO of Raymond James next on Market Catalysts. Raymond James shares higher despite missing Wall Street's estimates for earnings in the third quarter. Revenue did beat estimates. Raymond James CEO Paul Shoukry joining Yahoo Finance asking for a trend to break down those results.
Really pleased with the results that we generated in our third fiscal quarter. As you said, revenue's up 5%. But if you look at the first 9 months of the fiscal year in particular, revenues of $10.3 billion are up 10% over last year's record. So really a great year, testament to our diverse and complementary businesses, and really all the great work that our financial advisors, investment bankers, and professionals do for our clients each and every day.
Taking a step back, Paul, I am interested to get your thoughts on where you think we're at, where we stand with this U.S. economy. You have interesting line of sight there, of course. It does seem to be, Paul, proving resilient here, but I'm curious to get your take.
Oh, you're absolutely right. The United States is the most resilient economy in the world, and it's been incredibly resilient over the last 15 years, really, since the financial crisis. And so long term, we remain very optimistic about the economy. Right now, unemployment's very low. There's a lot of jobs available. The consumer remains strong. Inflation's moderated following the boost during COVID. And so long term, we're very confident about the economy. Short, intermediate term, there's a lot of variables and there's certainly some uncertainty, but we certainly remain confident about the long term. And what we focus on and what our financial advisors focus on with their clients is making sure that they're invested in their portfolios in a diversified way that helps them weather the storms over the near term to achieve their long-term objectives.
Also interested, Paul, to get your take on the general deal-making environment, what you're seeing there. You know, the expectation, of course, Paul, you know, Trump comes back to the White House and okay, here comes the M&A party, then tariffs. And I had folks on the show saying, well, now the concern is people are going to hunker down. They're going to get more cautious. What are you seeing?
It's a great question because that sentiment has been swinging a little bit like a pendulum over the last 6 or so months. The pipelines for M&A across the industry and certainly at Raymond James continues to build and continues to grow. There's a lot of pent-up demand from both buyers and sellers of companies, particularly from private equity firms and financial sponsors that have raised capital and want to deploy that capital, and also sellers that have invested in companies. And over the last couple of years, with the rapid rise in interest rates, there was sort of lackluster deal environment for the last couple of years. So there's a lot of pent-up demand. We came into the calendar year expecting a significant amount of realizations. And then with the uncertainty and shock, really, from Liberation Day in early April, that put a halt, kind of a grinding halt to M&A volumes across the industry. But now as that shock is wearing off, we're more optimistic about deals getting done over the next quarter or two, much more confident than we were over the last couple of quarters.
And finally, Paul, you know, listen, the stock market, as you know, it has been on a roll here. How do your clients feel about it, Paul? What are they telling you? Are they happy with that guidance they're getting from those financial advisors, Paul?
Yeah, it's a great question. I'm here at our Summer Development Conference in Orlando, Florida. It's an annual conference where over 1,000 advisors, family members, and children attend, which is really unique to Raymond James. I've been speaking to hundreds of advisors over the last couple of days, and they're expressing a lot of satisfaction from their clients. Actually, our internal surveys show 97% of client satisfaction with their financial advisor. Consumer sentiment and investor sentiments increased from 52% last quarter to 68% this quarter, a dramatic increase over the last quarter. So clients are confident about their relationships with their financial advisors. They're pleased with the service. We just won #1 for J.D. Power Service Award, and most importantly, the most trusted firm of any advisor-led firm. So our advisors have great relationships with their clients, and client sentiment has improved, and they're confident about their long-term financial plans. And I also want to mention we're celebrating here at our Summer Development Conference. Last night's earnings results was our 150th consecutive quarter of profitability through financial crises and other things, which again is really a testament of that long-term perspective we have, our financial professionals have, and keeping clients first and foremost.
I am curious, Paul, you know, in that market, you know, you're competing against a lot of very smart, effective, competent firms with a lot of smart, effective, competent financial advisors. What do you think you bring, Paul, that's different? What's the competitive advantage there?
We're an extremely competitive market environment. What our competitive advantage is, you see it here at our conference, is the culture. You know, we call it the best of both worlds value proposition. We want to be the absolute best firm for financial professionals and their clients. And we do that by offering the scale, scope of capabilities, technology. The technology demos are behind us. We spend $1 billion a year in technology, but coupling that with the family-friendly culture that we have at Raymond James. And as those financial advisors affiliate with Raymond James, which we're leaders in having them affiliate and retaining those advisors, they bring their clients over and provide excellent service to their clients as well.
Coming up this hour on Market Catalyst, first up, prognosis negative as uncertainty looms over the healthcare sector. We'll size up the headwinds that investors need to watch. Plus, a potential mega merger in the railroad industry. What are the risks and rewards of a Union Pacific deal with Norfolk Southern? We'll discuss. Plus, Paramount and Skydance get the okay from the FCC. What's next for not just them, but the streaming industry overall? All that and more coming up on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets right now. If we look at the major averages, all three are rising. Small gains today, but the S&P 500 and NASDAQ on track for record closes once again. The Dow also participating today. We've seen some divergences lately, but they're all up around 0.2% today. Managed care company Centene swung to a loss in its most recent quarter, blaming rising Medicare costs and ACA issues during the 3-month period. Centene struggles, part of a broader trend in the health insurance industry. Several insurers this earnings season, including Molina Healthcare and Elevance Health, have called out things like rising costs, regulation, and shifting membership. Here to talk about this backdrop and what it means for the future of the industry, Arthur Wong, S&P Global Ratings Healthcare Managing Director, and Adriel Bettelheim, Senior Healthcare Editor at Axios. Thank you both for being here. We appreciate it.
No, happy to be here. Thank you, Julie.
So it's interesting in the case of something like a Centene, which slashed its forecast for this year, but says it's focused on trying to make its ACA business profitable going ahead into 2026. Adriel, I want to start with you and what we've seen kind of big picture from the health insurance industry, which really seems to be grappling with some of the changes that are happening on the regulatory and reimbursement front. What do you think is sort of, or what have you been seeing in your reporting as sort of the biggest challenge there?
Well, it's probably the most volatile time for health policy since 2018, and I think some of them in their rate filings at least are anticipating both higher costs for care and higher demand. On the policy front, obviously the Big Beautiful Bill Act made the biggest package of changes to Medicaid, and that is going to bring, if estimates hold, about 10 million more uninsured. So there's the prospect of sicker risk pools, more uninsured people showing up in hospital emergency departments. But then also there's the anticipation that the Enhanced Affordable Care Act subsidies, which are due to expire at the end of this year, that the Republicans in Congress won't renew them. So that adds millions more uninsured, not uninsured, but leaving the ACA market. So I think the insurers are all factoring this volatility in both the higher costs and the changing risk, and it's definitely giving them jitters.
And Arthur, how do they possibly navigate in this kind of environment? How do you think they're adapting, and who's sort of doing the best job?
Yeah, I mean, it's tough to say in terms of on top of all the legislative changes and the uncertainty being brought about by the BBB Act. I mean, the insurers are already dealing with higher utilization rates for healthcare services, higher costs, and that's coming in from this labor inflation over the last several years. So it's been an issue they've been grappling with since the second half of 2023. So it'll be interesting to see in terms of what they do in terms of cutting costs or trying to lower the utilization. You've seen them trying to increase approval times for procedures. Also, from the service providers' perspective that we cover, we do see them in terms of their collections and in terms of their approvals, that those days have stretched out over the past year as well. That's had an impact for the service providers.
And Arthur, are there certain insurers that are more and less exposed to certain patient cohorts that will therefore make them sort of more and less vulnerable, or is the industry as a whole affected?
I think the whole industry, there are certain providers that are more exposed to the ACA market, the Medicaid market, or Medicare Advantage is also a market that's also been under pressure the last couple of years. So it's been a mix, but given how interrelated the whole healthcare system is, it's broadly hit across all of the health insurers.
Adriel, I want to ask you as well about United Health, because the company just confirming this week that it was responding to requests from the Justice Department, investigators on the both civil and criminal front. There's been some reports about those investigators looking into its Medicare business. And obviously, United Health has been under a microscope, both publicly and regulatorily, for a little while now. What have you seen in your reporting in terms of what that means for that company?
Yeah, we still don't know a lot of the details of the investigation, but it is, Medicare Advantage insurers are paid more to care for sicker patients. So there is this concern about upcoding, making the patient look sicker and collecting more in payments. And the Trump administration in general is looking at overbilling of Medicare by all sorts of providers, making that a priority. So I think the upcoding, particularly dealing with Optum, the United unit, is definitely a focus. There's also separate antitrust investigations and criminal investigations, which could, relate to a variety of things. So the admission, bearing out some of the earlier reporting by the Wall Street Journal, I think, puts them under especially close scrutiny. And we'll see if Congress is moved to act. There are some pieces of legislation addressing upcoding in Medicare Advantage that could be part of a deal if they choose to go that far sort of later in the year.
Has there been any sort of independent investigation, Adriel, into how prevalent upcoding is and how much, more that insurers are charging as a result of all this?
I think there's a general feeling that it kind of breaks a little bit along partisan lines, but certainly in the Democratic side, there's a feeling that they're overpaid and that there is a certain amount of fraud. And I think the Republicans are kind of they do love Medicare Advantage historically, and it does now account for more than half of the Medicare enrollees. So there's a reluctance to touch it too much. But I think it is a real concern that there's some more integrity. And that's why some of these proposals are putting it on CMS, on the Medicare administrators, to do look backs and to do a lot more oversight into the billings.
Arthur, I want to ask you as well from a regulatory front about the possibility of pharmaceutical tariffs and the effect then on the health insurance industry, and also the possibility of more negotiated drug prices, right? Those elements combined, what effect is that going to have on the industry?
Yeah, for the pharma industry, it'll definitely have a chilling effect in terms of its overall growth and its potential, its ability to fund its R&D needs. I think the possibility of tariffs, we recently published an article where, again, these are all based on estimates there's a lot of different moving parts, but our best guess is that it'll be a 450 to 500 basis point impact to their EBITDA margins. So it's something that may be manageable if it's given how high the margins are for the pharmaceutical industry isolated in itself, but it's still a significant impact. And the industry does have a lot of other challenges besides tariffs. And as you mentioned, there's a potential the various executive orders on pharma pricing, and then of course you have the Medicare drug price negotiation as part of the IRA that's going to go into effect in the following year, in the upcoming years.
Arthur, it's not as though the health insurance industry is ever super popular, but it feels like we are at sort of a low point right now. People need health insurance, so I wonder if there are implications for the business, or if it's just a matter of politically it being more palatable or acceptable for the administration to sort of crack down.
Yeah, look, I think both sides will agree. The importance of the healthcare industry, the health insurance industry, but I think what's going on in terms of the criticism that the health insurance industry is receiving at this point, PBMs, but I think it's also more broad than that. I think it's the healthcare industry in general. If you go back, it will be the pharma industry that's been receiving a lot of the criticism. So I think it reflects the importance of the industry, but also reflects the fact that there probably has to be some major restructuring in certain aspects of it, because with health expenditures projected to grow 5-6% a year for each of the year for the next 10 years, it's going to be unsustainable.
Right. Well, we'll see if anything from a structural perspective changes. Arthur, Adriel, thank you so much. Appreciate it.
Thank you.
Coming up, railroad giant Union Pacific has confirmed it's in talks to acquire a rival. We'll break down what that deal could look like and the implications for the industry next. There could be a mega merger in the railroad world. Union Pacific confirming it's in talks to acquire rival Norfolk Southern in a deal that could be worth over $60 billion. Following the confirmation, Ken Hexter, a BofA Securities transportation analyst, raised his price objective for Union Pacific stock to $271, up from $262. And he is joining us now. Ken, it's good to see you.
Hey, good morning, Julie.
So, why would it make sense to bring these two railroads together? When you're talking about two railroads, right, what kind of synergies are you talking about, especially since I don't think it would mean fewer rail lines, right?
No, in this case, it doesn't, right? In historical mergers, we've seen that. You know, back in the 80s, 90s, we saw a lot of overlapping mergers, whether it was Burlington Northern Santa Fe or UPSP. You actually saw them go in and then actually rip out network. This would be an end-to-end merger. So you're getting transcontinental, which you don't have in the United States. You have two in Canada, but we don't go from coast to coast in the U.S. So this would be about connectivity, and that's, you know, efficiency. So when you ask, what's the benefit? It's for customers, right? You can get, you don't have to spend a day and a half sitting in a yard as you transition from UP to an Eastern carrier. You can get a good solid flow through.
And why, that makes it sound logical, right? Has it just not happened before now for regulatory reasons, or have there been other historical obstacles?
Well, there's nothing magical about the Mississippi River in terms of how historical mergers occurred, but it is just, you know, what you saw a lot of initially was overlapping ones. Even, you know, Norfolk Southern and CSX split Conrail up in the late 90s. So you were looking at things where you had overlapping, and you could come to investors and say, we're doing this and we're just ripping out costs. This one is about growing. You know, how do you win business from the trucks? You have better service and you continue to grow. So you're right. The regulators have been hesitant before about allowing mergers. There was a proposal in 2000 to merge Burlington Northern and Canadian National, so one of the national Canadian railroads, and that's what launched a merger moratorium. So the STB said, wait a minute, we've just gone through a lot of mergers. Let's think about this. And part of that was you had to, it has to be for the public good, public interest, and you have to increase competition through the mergers. So that's what you have to walk away with. Well, now, is it just railroad competition, or are we increasing competition from the trucking? That's what this administration probably looks at when they look at this merger. And you're probably looking at how do you make the railroads more competitive for industrialization and everything else that this administration wants to drive on a domestic basis.
So do you think, how likely do you think then if they, you know, there's obviously a couple of ifs here, if the two actually agree on a deal, then do you think that there would be that regulatory approval?
Well, look, I think there's been a lot of opportunities where Jim Vena, the CEO of Union Pacific, has floated this. He did an article in mid-May where it was discussed amongst the industry. We had the chairman of the STB at our conference in mid-May. We've had Jim Vena at our conference on conference calls. So there's been a lot of talking about this before, you know, we got to this point where they've now confirmed that they are in discussions. And I think that's interesting because you haven't heard a loud voice come over the top and say, absolutely not, it's never going to happen. And I think that's why you have each of these progressive steps about discussions continuing, because, it's getting the market ready. But, you know, look, we'll certainly have time where regulators, government agencies, shippers, unions, all will have their voices heard through the STB process to see exactly what you're saying. What's going to be the outcome? Will it even be allowed to go through? Will there be things that they're going to have to give up, whether it's line sales or overlapping access to the network, something called open access for others to compete? So it'll be interesting to see where on the spectrum this comes out. But so far, the discussions are progressing. They noted that they're in advanced talks, and we'll see where it goes from here.
If the talks don't succeed, what then happens to the stocks, right? Because sometimes when you float these things, then they don't happen. What are the implications for investors?
Well, usually the implications are there's something wrong. Either you were trying for growth, you were trying for something as to why you needed to merge. This case, you know, they're trying to make the point that, you know, it would be good for shippers and good for investors. Union Pacific stock has barely moved. It's moved about 2% since mid-May. We've seen alternatively the others go up almost 20% for both the Eastern rails. So usually you'd have some paring back of the acquirees. You'd have a rebound in the one that is making the proposal. And that's just kind of a resettling in of taking out some premiums that might be put in the market. But I think what you'd have is the next step is, okay, if we can't integrate our networks by ownership, will there be other more alignment that we can do in terms of commercial agreements? And I think that's exactly what you saw when CP and Kansas City Southern merged. You immediately saw Canadian National, Union Pacific, and Ferromex try to increase their competitive relationship relative to a now single line CP KSU. So there certainly can be competitive responses to try to do what a merger can do. But certainly when you own an asset, you're also able to run a certain network a little bit smoother. So that's really what you have to do, is create the competitive environment to compete against a single line offering, just like we saw with CN and UP counter against CP KSU.
Ken, if this deal does happen, does that then ratchet up pressure on BNSF and CSX to do a deal also?
So I don't want to name particular names as far as who might have to do what. I just don't think we can kind of put other people in play. But certainly the competitive response from the industry would have to figure out a way to either, like I just mentioned, compete appropriately, whether it's through commercial agreements, whether it's through integration. You'll certainly find a way where those that are not offering that national integrated capacity might have to respond in some fashion, whether it's a full-out integration or commercial agreement. That's certainly to be resolved, but certainly it will put pressure on the peers. And you mentioned the one other Western and one other Eastern provider to figure out how they would want to compete in that environment if this goes through.
It's interesting, however you slice it. Ken, thank you so much for joining us on this. Appreciate it.
Thank you. Appreciate the time.
We got much more markets action coming up, including a market update from the NASDAQ and some of this morning's top trending tickers. Stay tuned.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ. Let's take a quick check on the market moves and the market action about 2 hours into today's trading session. What we're seeing is all three major indices roughly flat here. The NASDAQ and the S&P 500 really trying to hold on to that momentum, those record highs that they hit on Thursday's close. Taking a closer look over the past month, we've seen the NASDAQ yet again rise to those record highs. The number that we're looking for that index to close at is above 21,057. If we take a closer look at the S&P 500, also trying to hold on to that momentum here. The number that we're looking for there is above 6,363.35 cents. And investors are really trying to digest the latest economic data as they look out to the FOMC meeting next week, where we're largely expected to hold those interest rates steady. But of course, there's been lots of noise around Trump and Powell. Of course, these headlines around trade negotiations and tariffs also not impacting markets as much as we've seen in the past. If you also take a look, I want to really lend this opportunity to lean into gold. What we're seeing in gold this morning is that trade down about 1%, and that's largely because we're seeing this risk-on environment. We're seeing investors really be willing to take on that risk appetite, especially when it comes to that AI trade. Over the past month, we've seen names like NVIDIA, Google, Microsoft really move higher as investors are willing to take on, once again, that appetite around risk. Also taking a closer look at NVIDIA over the past month, we've seen that company continue to hold on the momentum as they've been able to maintain that AI revolution momentum behind it, as other companies have fallen behind, like Intel. We see now Intel stock down about 10% after the company really announced that they're going to do cost-saving cuts, like pull back on specific plants here in the U.S. as well as overseas, as well as lay off a certain percentage of their workforce. And really what investors wanted to hear was how they're going to maintain that rally within that AI trade, or rather join that rally in that AI trade. Of course, all eyes now will be on next week. We're looking for earnings when it comes to Apple, Meta, and Microsoft. So certainly those are three companies that we'll be keeping a close eye on as we make day. But right here, as you see today, all those companies roughly flat, as once again, the NASDAQ and the S&P 500 look to hold on to those record highs. Keep it right here on Yahoo Finance. We'll be tracking all the market moves during today's trading session.
Now Time for some of today's trending tickers. We're watching Lyft, Apple, and McDonald's. First up, Lyft partnering with an Austrian manufacturer on autonomous shuttles, eyeing a potential 2026 launch in the U.S. This comes as Lyft attempts to keep up with rideshare rivals like Uber and Waymo that are embracing driverless rides. Lyft saying it aims to offer the shuttles in partnership with U.S. airports and cities. Lyft's first driverless rides are set to debut later this year in Atlanta in partnership with a different company, May Mobility. I don't know about you, Brooke. Brooke is still with me. Brooke DePaula at the NASDAQ, by the way, is still with me. I don't know about you, Brooke. It has seemed to be an unusually busy week in terms of announcements from both Lyft and Uber about sort of new initiatives that they're working on.
Certainly, lots of noise coming from Uber and Lyft. And it seems sort of here, Julie, that they're going tit for tat. Of course, earlier this week, we heard about a partnership with those female drivers. That's something that Lyft has already been doing. Then Uber announced that. But if you take a look at the momentum behind Uber stock versus the momentum behind Lyft, Lyft clearly looking to get ahead, especially around all this noise around autonomous vehicles, especially over this past month. Of course, we heard about that robo-taxi from Tesla back in June. But if you take a look, Lyft stock up about 10% year to date, but it's still trading around $14 per share. If you take a look at Uber stock, it's a far different story there. Over the past, or rather, now 7 months, year to date, what we've seen is that company, its stock rise more than 50%. Uber stock currently sitting around $90 per share. We know that Uber already has this sort of autonomous vehicle partnership with Waymo, and that's happening in what I've seen in Phoenix. Julie, I saw someone get into this driverless vehicle, and I was absolutely blown away. And it seems like Lyft really trying to get that similar excitement here as well.
Yeah, and getting excitement in the shares, too. Their shares are up about 10% this year. Uber shares are up about 50% this year. So I'm sure they would like some of that juice also. Next up, let's talk about Apple, because it's getting a positive read from JP Morgan ahead of the tech giant's earnings on July 31st. Analyst Samik Chatterjee says he's anticipating less than expected supply chain pressure on the quarter's sales as consumers potentially rush to buy additional products ahead of the tariff deadline. However, Apple is still one of the laggards of the Magnificent Seven year to date. It is down by about 14% thus far this year, Brooke.
Yeah, I'm taking a look at the YF Interactive. It's down 14%, and that's compared to NVIDIA's nearly 30% gain, Microsoft's 22% gain, and even Meta really getting in on that AI trade as well, with shares up 22%, nearly 23% there. But this has been quite the story for Apple. If you take a look what we've seen over this past 7 months as we make our way more than, into the third quarter, what we've seen is Apple really get swooped up, especially back in April, around what could have been this quote-unquote $3,000 iPhone because of these tariffs. And now we've also seen it fall behind in this AI trade. And largely what we're hearing from investors this morning, or rather analysts on the street, Laura Martin saying in a note this morning that she specifically will be looking at those iPhone sales. She'll also be looking at their services revenue, something that really has been instrumental, both the iPhone and services revenue for Apple to really stay in the game here. But of course, not just Laura calling for Apple to really pick up on their race in AI, pick up the speed on their initiatives there. But there has been a slew of calls on the street for Apple to really figure this out on how it can get even a pulse, a hand in this sort of momentum that others within the Mag 7 are seeing because of AI.
Yeah. And let's talk about another stock that you follow closely. That's McDonald's, introducing a new line of more premium drink options that could include cold brews and sodas with dried fruit and flavored syrups. That's according to the Wall Street Journal. It comes as McDonald's estimates the beverage business could be worth $100 billion across the U.S., Canada, Australia, and parts of Europe. The new drinks line would be offered at 500 McDonald's locations, potentially starting in September. Brooke, we know that the cold drink trend has been pretty powerful.
The cold drink trend has been pretty powerful. We've seen Starbucks benefit from it in the past, maybe not so much right now, but McDonald's certainly looking to get in on that. The Wall Street Journal citing this morning that sales and at beverage and snack-focused restaurants chains grew 9.6% last year, while burger chains only grew 1.4%. And that's what we've seen is these companies really lend themselves to these sodas, these different types of drinks. We know that KFC is looking to make a dirty soda. Also Taco Bell, which is really giving momentum to Yum brand stock. That stock up more than 8%, outpacing others within the QSR space so far this year. Yum brand's Taco Bell, they're weighing in with this Live Más Cafe. Of course, Live Más, their brand. Now they're going to have different cafe coffee offerings as well. And this is really all in this play to get consumers back in the door, trying to play into what consumers want right now. They want this crazy innovation. They want to try something new. And this is interesting. This is actually off of the ending of McDonald's Cosmic, that out of the chain coffee chain that they had announced last year, or rather in late 2023. It actually closed back in May. And so now we're seeing a bit of those trickling of those findings come out. We'll see that in September once again at McDonald's, these different fun coffee, dirty soda. I don't know if maybe I'll try one. I don't know about you, Julie, but.
No. But you never know. All right, thanks a lot, Brooke. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, move over eggs. Beef is the new highly inflated grocery store item on the shelves. Prices have increased over 8% so far this year, hitting $9.26 per pound as of June. That's according to the USDA. Here to break down the catalyst behind these rising prices is Michael Swanson, Chief Agricultural Economist for the Wells Fargo Agri-Food Institute. Thanks for being here. It's good to see you. So, I don't know that beef and eggs are directly comparable, right? The egg prices were very volatile as we were seeing them sort of go up and then come back down. What's going on with beef that's causing these issues?
It's interesting. If you think about an analogy, eggs are kind of a sports car. They really move in a hurry. Beef is more of a train. It kind of goes slowly. You can see things out in the future and you anticipate that. What we saw was a drought 2 or 3 years ago. Low prices really hurt their performance in terms of their profitability. And today they're just short cattle. And it's going to take 2 or 3 years to fix the problem.
What effect, if any, do tariffs have on the U.S. cattle business?
Typically none in the past, but we're kind of in a new moment right now. We used to be kind of a net neutral for exporting, importing beef. We sent out high-end steaks to Japan and China, brought in grind beef from Australia. Right now, we're 8% of our supply is coming from overseas. So that's not normal. That's kind of new. So we're going to have to wait and see what this means to the consumer at the end of the day, price-wise.
Well, I was also interested as I was reading into this, Michael. It's almost like oil, that there are certain kinds of beef that we consume in the U.S., ground beef, for example, that's sort of a different mix that is not necessarily all produced in the U.S. Can you explain that for viewers?
Absolutely. It's a great observation. So we usually finish the beef in a cattle yard. Give them a super ration of corn and soybean meal, and just basically they're going to turn pretty fatty. And on the other side, a lot of the cattle that we are importing from outside the beef is grass-fed. It's out on the range, walking around, getting its exercise. So it's pretty lean. So we kind of blend the two together to get exactly what we want.
Gotcha. So that makes sense when we're getting some of the increase or the imports that are going to that. So what's the outlook then for beef prices, given some of the things you're talking about?
It's going to be high for the next 3 or 4 quarters at least. And the consumer is staying with us. We haven't seen, the reason why we have these high prices is because the consumer hasn't said no yet. And in fact, we're eating a little bit more beef this year than last year, even at these record prices. So, it's going to be there. The question is who gets what share. This is a supply chain that never is constant. We saw the Packers have an incredible share back in 2021. Now we're back down. Right now, it's the cattle ranchers' turn to shine. So it's going to be interesting to see how we discover who gets what. But prices are going to stay strong for the foreseeable future.
And Michael, I want to turn to another big story in agriculture, and that is sugar and the shift here at least with some products from Coca-Cola, to maybe being made with sugar instead of corn syrup. What does this do to supply chains?
It kind of repoints it. We've been using all the sugarcane sugar that we have, and it's been going to the highest bidder. Well, we have pretty good supply of sugarcane sugar here in the United States, and we can import it if we need to, but it's going to be see who's going to bid more for it. In the past, maybe it wasn't the soft drink manufacturers that wanted to pay the premium. We have it. It's just going to be interesting to see who wants to pay for it, put it on their label, and whether the consumer actually wants to pay that premium.
So in other words, sugar prices could go up as a result of this.
They could. We can produce more sugar. We have plenty of ground. We have plenty of capacity. But once again, you don't turn a dime in crops. It takes a few years to get things to happen. But if we have a much better demand for sugarcane sugar, Louisiana, Texas, they're ready to produce more sugar, because if they make money, they'll do it.
It makes sense. Michael, thanks so much. It's good to see you.
It's good to be on. Thank you.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
The S&P 500 is up over 300% this century, but it only turned positive in 2013, and there has been a lot of volatility. We've been looking at cyclicals versus defensive sectors the last 2 days. Today, we're going to look at how to smooth out your portfolio with managed futures and bonds. And first, let's review the definition of managed futures. These are rules-based accounts or funds, including ETFs, that go long or short futures across stocks, bonds, commodities, and foreign exchange. They're different from a straight allocation to, say, gold or silver or a commodities index. And that's because they will trade in and out of different commodities. They try to time the market. So let's take a look at how stocks and bonds and managed futures have stacked up together over some periods of difficulty. And this table is prepared by Strategas ETF, Todd Sohn. We've had him on Stocks in Translation before. And you're looking at three different markets. The SPDR S&P 500 ETF, so we got SPY there. And then we have an ETF AOR that covers the 60-40, that's 60% stocks, 40% bond allocation. And then we have the SGI CTA Managed Futures Index. So that's managed futures. And what you're going to see is that during the 2018 Fed tantrum, the S&P was down about 1/5. Over COVID, it was down about 1/3. Over 22, that inflation wave, it lost 1/4. And then again, almost 1/5 during the 2025 tariff tantrum. Now, if you take a look at what bonds did, they lost a little bit less here, 10% versus 22, 21, 10% again. And then managed futures lost even less. But what really sticks out here is this one outlier, this green box where managed futures managed to rise 32.8% during that 2022 inflation wave, which tells me that they have done a better job at hedging risk than bonds did, because bonds only added to the losses that stocks had during that 2022 drawdown. And also 2023 was a bad year for bonds as well. So here is a chart that takes the S&P 500 for stocks. In green, we have the Bloomberg Aggregate Bond Index. And then in managed futures, I'm using the SG CTA Index, which is a little bit different than the one I was just showing. But this time series goes all the way back to the beginning of the century. And what I said before, the S&P 500 only turned positive in 2013, and that's because there was a double top created by the dot-com boom and also the global financial crisis high. But then it managed to gain 333% from those lows to this high right here. And then in the meantime, bonds had a more steady incline, and over that period, they've eked out about 172%, which is a nice return there. And managed futures, coincidentally, and this is pure coincidence, they managed to also return about 170%. But the paths by which bonds got there and managed futures got there were a bit different. Bonds had a more steady incline into about the early pandemic, but then they had a huge decline in that 2022 year that I was talking about. Meanwhile, managed futures tended to go sideways. There's a little bit of an uptick here, but they tended to go sideways to down in the teens. And that's when we had those near zero interest rates combined with low growth. Arguably, we have transformed into a new market environment, but I'll get to that in a second, because now I want to show you what the allocation looks like if you have just 100% stocks, and that's going to be the S&P 500 in white. So that's basically the same white line as the previous chart. But then in green, we have 60% stocks and 40% bonds. And then in blue, we have 60% stocks and 40% managed futures. And since the total return of both bonds and managed futures was the same amount, well, guess what? The allocations for them, the 60-40 either way, is going to also be the same. And if you were to do a 60-20-20 portfolio, it would kind of be in between these green and blue lines. But I didn't want to complicate the situation unnecessarily. We have to move on. I want to show you a table of all the stats put together. But first, I need to define the Sharpe ratio for you. This is the excess return over the risk-free treasury rate divided by volatility. So this shows you how much reward you can earn per unit of risk. And this is kind of the standard. When people talk about volatility adjusted risk, they want to take out that risk-free rate. And let's say the S&P 500 earned returned 10% this year, and treasury bills are returning 4%. Well, you only give credit for the S&P 500 6%. That's beyond that 4% to reach that 10%. So that's the critical distinction there. Now, to break down this chart, S&P 500 by itself got a return of 333%, bonds 172%, coincidentally managed futures right there with it, 173%. Average daily returns are going to be about the same for both managed futures and bonds. And then we look at risk, standard deviation of the daily returns. The higher this number, the more the risk, the more volatility you suffer. And so we had 1.23% risk in the S&P 500 or stocks, compared with a much lower number for bonds, 0.27, and a lower number for managed futures as well, 0.53. Although managed futures managed to be twice that risk of bonds. And now here's a key stat, Sharpe ratio, and I'm going to go over this. We have the S&P 500 with a Sharpe ratio of 0.33, and we want to see this number larger. A larger number is better. Bonds by themselves were 0.65, and managed futures 0.33. So for instance, if you were to compare the S&P 500 to managed futures, you have a much higher return, 333%, with about the same amount of risk. But why would you want to combine them? Because they will do differently. They will perform differently at different parts of the business cycle. And so you want something that's going to buffer those stock losses with hopefully gains. And that's part of what managed futures and bonds are supposed to do, but they don't always do that. So here we have, instead of each of the markets by themselves, this is my final slide, this is a blended portfolio. So in this column, we have S&P 500 versus bonds, that's 60-40. Then we have S&P 500 versus managed futures, 60-40. And then we have S&P, bonds, and managed futures. That's a 60-20-20 portfolio. And you can see the returns are just about the same for all three of those. Again, that's just a coincidence. Same for the average daily returns. But then when you get into the risk, you're going to see a higher risk, actually, the highest risk for that 60-20-20 portfolio. And if you're looking at the Sharpe ratio going for the largest number, it happens to be bonds, S&P 500 and bonds 60-40 portfolio, although it's not that much higher than some of the other categories. Excuse me. A lot of talking here. The bottom line is I do believe we're in a different market environment. And as I was saying, managed futures managed to perform admirably well during the downturn of 2022 when we had a lot of risk, but we also had things in commodities that were trending well. And that has to do with the higher inflation environment and also the fact that we have maintained higher growth as opposed to what we were seeing in the teens. So going forward, if we are in a new playbook, you might want to consider some of these alternative investments like managed futures for your portfolio. And tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. More market catalysts after this.
The FCC approved Skydance Media's $8 billion bid to merge with CBS partner company Paramount. The approval coming with several concessions made to the Trump administration after settling a lawsuit with the president earlier this month over a 60 Minutes interview that Trump claimed was election interference. Robert Fishman, MoffettNathanson senior analyst, joins us now to discuss. Robert, this is a fun one to talk about, right? Because of all of this stuff going around it, right? You know, in terms of the politics, in terms of the Colbert cancellation, et cetera. But when it comes down to it, has Paramount been a good investment for people?
Well, over the long term, I think that there's a clear answer that unfortunately the answer is no to that. But as far as where we are today, I think what Skydance is looking to do is obviously try to turn that around with adding capital and removing the challenges that Paramount has had in terms of the debt overhang. So really what Skydance and the consortium is looking to do, not going to be a very easy task, but at least hopeful to do, is really reinvigorate the company through adding capital and really trying to invest in this company going forward.
Robert, are there any implications from the 60-minute settlement, the Colbert cancellation? You know, we had, of course, the South Park episode criticizing Trump and Paramount for that matter. Is there any implications from that friction between the content creating side of the business and the management side of the business?
Well, for now, I think everything is at least trying to figure that answer out. So I think given that it hasn't been under the Skydance necessarily ownership, because the ownership has not been formally transferred yet, you mentioned that they did just get the FCC approval. So I think all of that has been under the current ownership. So the question as far as that you're asking is really remains to be seen as far as what the impact is going to be going forward once Skydance takes over.
What do you think happens with the sports business, CBS Sports there?
Yeah, it's a really great question, one that we spent a lot of time starting to think about. Really, what this comes down to is the importance of sports within the overall company and the strategy going forward for all of these media companies, but even more so for CBS and CBS Sports and what that means for Paramount going forward, because clearly the focus of this company and the growth that Skydance is hoping to stand to benefit from is really going to be from Paramount Plus. So we've long criticized Paramount Plus in terms of essentially giving away all of this sports content as part of their streaming offering at a significant discount to the general population, to all of the viewers and subscribers. But really what Skydance can come in and try to reshape this sports strategy, whether they want to make sports a premium event at this company and how they're going to include that within Paramount Plus is an open question. How much they're really going to be investing in sports going forward. We think that there's clearly an appetite and a strong desire, given the importance that sports still means to this company and to some of the executives that are taking over. But at the same time, the question is, are they willing to put all of their new investments towards sports, or do they feel like they have to spread it out to different content genres?
And since we're talking sports, I am curious to ask you as well about the report that NBC was exploring another sports channel of some kind, right? And it's especially interesting that seems to be a linear channel and not a streaming channel, which is that puzzling in today's environment?
So Craig Moffat at our firm is the one that covers Comcast. What I can say, obviously, is this does look like a step going in a different direction that everyone else seems to be heading. So it's nothing officially that was announced yet at this point, but definitely one that raises a lot of questions in terms of what the appetite really will be for another sports traditional cable network. And really, who is going to engage and sign up for something like that, given the sports rights that they have? So something definitely to continue to watch there.
Yeah, it's a great question. We'll see. Robert, thank you so much. Appreciate it.
Thanks for having me.
That's it for Market Catalyst. I'm Julie Hyman. Have a fantastic weekend and keep it right here for more Yahoo Finance.